Welcome to our second part of our BRI Investor Survey video summary. In this part, we want to take a closer look at asset allocation and whether the different alternative asset classes have performed as the participants would have liked. But at first, a quick reminder. The BRI surveyed around 109 German institutional investors who together have assets of more than 2.4 trillion euros. We refer to this group as limited partners, LPs, in the following. In addition, for the third time, we surveyed 114 BRI member companies worldwide operating asset management and service providers. We refer to this group as general partners, GPs, in the following. Every year, our survey participants are asked whether they want to increase or decrease their allocation in the respective asset class or want to maintain the status quo. Here you can see the results of this year's survey. Corporate private equity and debt, as well as infrastructure investments, will probably perform best in fundraising. By contrast, investors in real estate continue to be rather cautious. But let me show you how the 2023 results has changed compared to the 2022 results. In other words, where will capital flow migrate to? The bars show you the delta of investors' targeted allocation adjustments for each asset class in 2023 compared to the results from 2022. One can see clearly that there are certain fluctuations in the target asset allocation. With the exception of infrastructure, equity and debt, the fluctuations here can still be interpreted as marginal compared to the previous year. The biggest change can be seen on the far right is in hedge funds and liquid alternatives. In the BRI Investor Survey 2022, 84% said they would not change their allocation for the time being and would wait and see. This wait-and-see approach seems to have come to an end. 27% of the original 84% have made a decision. Surprisingly, it is almost 50-50, and 14% have moved to increase and 13% to decrease. The change in corporate private debt is also interesting. Here, 15% abandoned their wait-and-see attitude and decided to increase or reduce their allocation, again with a 50-50 split. The negative sentiment in the real estate sector is clearly evident. In both the equity and debt sectors, over 10% of the participants want to reduce their allocation. The majority of these votes were still in favor of an increase last year, so you can see the clear shift from increasing to decreasing. Last but not least, private equity seems to be slowing down for the time being. Compared to last year, 13% of participants do not want to increase their allocation here any further and are adjusting to a status quo. According to the respondents, infrastructure and private equity seem to have fulfilled their expectations. In the case of private debt, opinions are more divided, but still in a positive range. On the other hand, investors expected more from their real estate investments, especially in times of high inflation. After a long upward phase, the real estate sector is now suffering a setback for the first time in years. Overall, the opinions cover the entire range with a concentration of votes rather in the lower midfield. Hedge funds and liquid alternatives seems to be more in the midfield or upper midfield. In the last part of our BRI Investor Survey video series, we want to go into more detail on individual questions and the respondents' attitudes to certain topics. For example, which categories investors use to select an asset manager and whether private markets are better suited for ESG investing.